Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. All three of you? Just kidding. Oh, man, I got a lot of stuff to go through today. We're going to have a guest on today. She's going to call in a little bit later. It's a little bit in the show. And she has her own insurance agency. Her name is Tony Weston. And the insurance company is called Ohio Arc Insurance. They represent several different companies. And the reason I brought him on is I had not looked at my insurance in a long time, probably more than a decade. Actually, I know it was more than a decade. And I was able to increase the amount of coverage I had substantially, and I'm paying less for it. So I guess that's one of those things you should probably do more than once every 10 years or so. But anyway, so she'll be calling in, and we'll talk a little bit about that. And there's some pretty interesting stuff out there. And it's one of the things that, as I've grown in this business, I've come to realize a long time ago, is that you got to have specialists, because everything is complicated today. Yeah, I mean, the taxes, it's unbelievable how complicated that's become. Estate planning, there's different types of estate planning, depending on how big your estate is and what you're trying to do. And there are people out there that focus on that. You got investment planning, which, you don't really hear that a whole lot. Most people just think, it's part of the job of somebody who does everything or does it all. And I'd be really hesitant to want to do business with a firm that claims that they can do it all if they don't have various departments that handle that. And, those are, you're talking, I've never even seen one of those. You need somebody that's really good at insurance, and it's got to be health insurance is different than homeowners insurance. It's different than the personal liability. So bottom line is you need a team of professionals. And one of the things I try to do at my small firm is I have people that I've used over the years and can refer other people to whenever they call in and they have those questions. So, and that's one of the benefits of having been around for 32 years is you meet a lot of people and you have lots of experiences, and some good, some not so much. And that experience is a really good teacher. So whenever I give somebody a referral, I know that I've had really good experience with those people. So anyway, you can take it for what it's worth, but we'll be talking a little bit about that. And we're going to talk about, we always kind of talk about where's fixed income today. That hasn't really changed a whole lot. We'll talk about the markets, the economy. The economy is really strong, incredibly strong. What does that mean, going forward? We get that a lot. I hear that question being bannered about a lot. And what do you think is going to happen? Well, realistically, you don't know exactly when things are going to happen, but you have a pretty good idea of the general direction. And most of the time, it is up. It's up. The vast majority of things rise in value over time. Inflation makes the prices on things go up. It's really interesting. My mother gave me an old magazine that she'd found. I thought I would be interested in it, and it's I'm trying to remember what it was. Some of the articles in there, but I'm looking at the prices on the ads, and it was from the mid 1930s, and you could buy a brand new car for $500. Brand new car for $500. I had to look that up to see if that was accurate. It was Saturday Evening Post. By the way, I did not realize that the Saturday Evening Post, if you're under the age of 40, you probably have no idea what I'm talking about. But there was this magazine. It was super popular. And there was a painter who was made famous he painted the images that would show up on the cover of the magazine. And now I forgot what his name is. Don't get old, people. But anyway, the Saturday Evening Post, and that was started by Benjamin Franklin. That blows my mind. That really blows my mind. And it was still really popular, and it actually was really wild. The long stories that were in this magazine, I mean, they were almost the size of books, some of them. But so anyways, it was pretty fascinating to see that. And looking at all the prices, they were advertising shoes. You know, somebody takes out an ad in a national magazine to advertise their shoes. It was Florsheim. You may not have heard of that. If you're above the age of 50, you probably had. If you're above the age of 65, I know you have the Florsheim shoes. They were $6. You're taking out an ad in a national magazine, arguably one of the most popular magazines of its era, and the ad and the shoes are $6. So my point is, inflation is just a given. That's how things work. Stocks have a tendency to keep up with and outpace the rate of inflation better than other asset classes have over time. You know, if you listen to the disclaimer at each of the beginning of my shows, I have to say, you know, you can't guarantee this is going to happen in the future. That's part of being a financial advisor. In general, prices are probably going to rise going forward with a lot of the things that are going on now. They're rising a little faster than they have in a very long time. Lots of different reasons for that, but stock market's been going up. A lot of companies' sales have increased. Actually, the pandemic has actually helped a tremendous number of companies, especially in the healthcare industries. But it's caused their revenues to rise really quickly, and profit margins are expanding, and that's amazing. Okay, so, and I'm sure 10 years from now, there's a really high chance stock prices are going to be a lot higher than they are today. 20 years from now, I really, you'd have a tough time convincing me that it's not going to outperform all the other asset classes. And that's one of the reasons that stocks do so well, or are so popular, rather, because they've actually done very well. Why have they done well? Well, because Procter & Gamble and Hershey's and Clorox, they're not going to take those increases in inflation on the chin. They're going to raise their prices enough to cover that expense minimally. And, we all just think the grocery store owner is trying to gouge us. But I'm just kidding, kind of. But that's basically why stocks have been better investments than other types of investments. Now, back in the 70s, when you could get treasuries or savings accounts that were, money markets were actually invented near the end of the 70s. And money market account today, a lot of people don't realize it. People thought of them as savings accounts. That's what they thought of them as. And the very first one was actually invented here in Ohio, actually in Cleveland, by one of my former clients, who's actually since passed away. But it's been a while now. But the bottom line is something like similar to a savings account that was paying 18%. That was nuts. And it was the first time that it ever happened in the history of this country anyway. And is it going to happen again? That's the big question. I don't know. I don't think so. So my personal opinion is I don't think that it's going to happen again. I don't think you'll see interest rates getting that high. If you do, the big sucking sound you hear across the world will be money coming out of stocks and going into savings accounts earning 18%. I think it's pretty funny. Even Peter Lynch, Peter, if you don't know a lot of people don't know who he is anymore because he's been retired for so long. This guy's track record, you should look him up. His track record was phenomenal. I don't think anybody's ever matched that track record again in a publicly held mutual fund. Okay, so he put nearly half the stock fund. People didn't realize his was not a stock fund. It was actually a capital appreciation fund. He had half the money in bonds earning 15%, long-term government bonds. And when you have bonds earning 15% and all of a sudden interest rates start going down to 10, those bonds become more and more valuable. So in addition to the 15% interest you were getting, the principal was going way up at the same time. Was beating the dog out of the stock market for about 5 or 6 years in a row. Anyway, one of the things I wanted to talk about today, we're going to kind of segue a little bit, break off, and I'm going to talk about Ohio Ark Insurance. And go to ohioarkinsurance.com because right now I have Tony Wesson on the phone. Tony, are you there?
I am. Hello, Bill.
Hey, how are you?
I'm great. Thanks for having me.
Oh, no problem. Boy, you're coming in nice and clear, so it must have a really good connection. That's
excellent.
Yep, that's pretty awesome. So I don't know if you'd listened to the first portion of the show, but I was talking about what you did and what you did for me. I have to admit, I had not shopped my insurances for at least a decade until you and I talked. And then I realized I got a lot more coverage for less money and probably should have been in touch with you a lot earlier. But and I know that you can't promise that's going to happen all the time, but I think just reviewing that kind of stuff is very, very helpful. And so I was impressed with the service that you guys provided and still provide. So it's let's see, if somebody wanted to get in touch with you, what is the easiest way to get in touch with you?
The easiest way would be to just pick up a phone and call me at 216-645-9008. I do have my website, as you mentioned, ohioarkinsurance.com. And then you can always email me, but you can find all of that information on the website as well. Okay,
great. That's awesome. And one of the things I did want to talk to you about and point out was we were able to add an umbrella policy to my policy. Yeah. And I got to tell you today, that is just, to me, having seen the kind of stuff I've seen in my career, we're never allowed to name names, and I don't want to go specifically, but I can tell you that if you have a car or a home, you've got a lot of liability that a lot of people don't really think of, and you need to get that protected, at least to the best that you can. And so I thought that's a great place for somebody to start if they're just starting out. If you just got out of college and you're renting your first apartment, well, there's a renter's insurance you can talk about, but liability insurance might be something that you'd want to add because it's relatively inexpensive. And I think, can you add that? We kind of bundled it with the car insurance. I didn't know if that was normal or if that was.
You bundle, yes. Your home, the main policy is usually with a home or a condo, and then as long as you have some kind of home insurance or apartment even, you can couple that with your auto insurance and then put an umbrella over both with the liability insurance. So it's an additional liability buffer. And people don't realize that umbrella policies, increased liability, isn't just for the rich and risk taker. There are so many risks that a person doesn't realize, but the most riskiest thing that we all do is drive a car.
Right.
And to have an extra layer of liability to protect you for anything that you might do unintentionally on the road to someone else,
right,
is priceless, for sure.
Right. Yeah, it reminded me of a lot of the financial planning classes that I had taken a long time ago, and that's one of the things I wasn't really fond of with a lot of the financial planning designations. This is an area where if you're not up on it, just like my experience, I had less coverage and was paying a lot more money for it. you just can't be an expert at all things. It's just not possible, especially in today's day and age. So, and I think so that's where you guys come in and can help people. And notice you dealt with more than actually. I think you've added a couple of companies since I bought my insurance. So that's good.
Yeah, I am an independent agent, so I can look for any unique situation. Everybody has a unique,
sure, array
of needs. But I want to say that I am an Erie representative. I represent Erie Insurance, and not all insurance companies are the same. While I have several carriers, I want to say that it's very important that you research the carrier, the insurance company that represents for you.
Right.
That is,
yes,
that's going to help you in your worst day.
Right. Being an investment advisor, looking into insurance companies, having invested in insurance companies before, I can tell you that insurance companies can go broke, and they do. So if you've got policies and it's with a carrier that goes out of business, it can be really rough, to say the least. So yeah, that's a big deal. You want to make sure that you try to go with the more highly rated carriers, and that's where people like you can come in and kind of help them, point them in the right direction. And so I think that was, I was really happy with the work that we had done together. And I know we talked about getting together on our show for a very long time. Sorry it took so long.
No, it's very, very good. If I may point out that not only auto insurance is a huge risk, but people don't realize that your backyard family fun, your swimming pool,
right,
your trampoline, anytime you entertain with alcohol, there are so many risks that you don't really think about that can affect you from a third party.
Right.
So
yep.
Definitely, if you have anything to protect, and we all do, even no matter how small or how large, it's peace of mind for sure. And it's very inexpensive. There's no reason to overlook this one.
Right. Absolutely. When I saw what I was getting for the payment, I was shocked. I was absolutely shocked. So, yep. Again, let's give out that website one more time.
www.ohioarcinsurance.com.
All right, Tony. Thanks for calling. I had to take a real quick commercial break, and have a good week. And I'll be talking to you soon.
Thank you so much. Bye bye.
It's Bill Bullington right here on 1420. I'll be right back.
I never got it right. This world can be cold and bitter. Feels like we're in the dead of winter, waiting on something better. But am I really gonna hide forever? Over and over again.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can go to my website, bullingtoncapital.com. You can you actually can listen to the show as a podcast there too. It's also, I think it's on Apple, iTunes, and some other places. But if you just type it in and go to Google it'll bring up several different options. And so we were just talking a little bit about the insurance company. I found her. She was listening to the show and called in, and I had not reviewed my insurance in a long time. So I was surprised that the rate differential was pretty significant. I'm sure that doesn't happen every time, but hey, you never know. So anyway, talking about insurance, what insurance does is you're trying to manage the amount of risk you're taking, which is incredibly close to managing portfolios. In fact, I'm going to tell you that it is all about managing the risk. It's not so much being a good stock picker or a good fund picker. There are lots of good stocks, lots of good funds out there, but you've got to manage the overall risk and know the difference between a super speculative fund or a super speculative stock and what might be more considered By the way, the reason I'm stammering is my headset keeps going out on me. And really difficult to talk when you hear this stuff. You can hear your voice and then it goes away, but never mind. Hopefully we'll get that fixed here pretty soon. So, and we were talking about managing risk, and that's a big deal. Whether you're managing a portfolio, you're trying to manage your financial life, 90% of it is managing risk. And the 10% comes into the selection part. If you do a good job managing the risk, it's going to make your selections a lot better. What do I mean by that? Well, you can have products that have guarantees on them. You can have stocks that have no guarantees. And generally, the higher the risk, the higher the potential return. Not always, but generally, the higher risk you're going to take, the higher your potential returns are. And I think it's funny, I'll have clients that have more than one account, and one of those accounts is going to be super aggressive. And not super aggressive, but it's going to be more aggressive. It'll be almost 100% stock, and we will overweight a couple of industries in there that I feel like have a better shot based on their sales growth and their profitability of performing better. You guys have heard me talk about my semiconductor healthcare model. That's what I'm referring to. So that portfolio, when the market's doing well, everybody wants that. Let's put all of our money in that. Well, maybe not. We just have to kind of assess how much we should put in there, because when the market comes down, those things that go up the fastest, guess what happens when they're going down? You got it. They go down pretty fast. So you have to be really careful when you're looking at the fund's performance and finding out how are they getting that performance? What are they doing? And that's one of the things, I think, when you're looking at a lot of the annuities, we talked about that. I'm going to talk a little bit about it because fixed income bonds are paying so little. The interest rates on bonds are so low that a lot of the annuities make a really good, viable alternative. They're not the same thing. They're an alternative. That means different. A different choice, a different option for a portion of your portfolio. And it really depends on how much, what you're looking for, how much income you'd like to generate. You got to be really careful about the inflation rates, because if you locked all of your money up into a fixed product, it's basically fixed. So there's no getting out of that without paying a lot of penalties sometimes. Some of the annuities don't have penalties. Some of them will let you take money right back out again without giving you a penalty. Those normally have lower guaranteed rates. And the longer you are willing to sit on something and tie it up, the higher the interest rate is going to be, because the insurance company can afford to make longer term investments, which also can have adverse reactions if something happens to the financial system. So again, the higher the rate of return, probably the more difficult it's going to be to get out without paying some sort of a penalty. Now, having said that, there is an investment only annuity out there. It's an investment only product. It has no penalties for early withdrawal. The guarantees that you can add to it, they're called riders. They're like little insurance policies. Again, we're trying to manage risk here. So if you wanted to guarantee, say, a certain income, you can add that rider to it. You can also take that rider back off and they'll stop charging you for it. So that's really unique, by the way. That's new. I really like that stuff a lot because it gives you a lot more choices. And a lot of the mutual fund families in there, Fidelity, Vanguard, T. Rowe Price, you name it. It's like 300 some odd funds in there. It works like a big non-deductible IRA in a lot of ways, because you put money in, you're not allowed to deduct what you put in it unless it is an IRA, because you can use this for IRAs. But it's tax deferred, and you get to decide. There are no ages where you have to start taking money out of it. So that's pretty good. I got to go right to the phones. And by the way, if you'd like to call, 216-901-0945, 216-901-0945. And I got Phil. Is this Uncle Phil?
No, this is Phil.
Oh, okay. I'm sorry.
Yes, I wanted to know what you thought about tips.
I think that they can be good, but a lot of the prices in a lot of those bonds are up so high that even if you put the inflation adjustment on there, you're still not going to make much money. And but as far as safety goes, if you hold it to maturity, then you're pretty good. If it's the ones that don't mature, you've got to be very careful with that, because that risk there is you can't even calculate it; it's unknown. So,
is it better to go into a fund, tips fund?
With the interest rates being so low, I'm not sure that it would be beneficial to pay a management fee on top of a bond that's not really going to pay a whole lot. Does that make sense? And it's become, I've probably had 5 people ask because of the over the last 3 weeks that, tips, and there are other types of inflation adjusted government bonds. A lot of them don't have, or they have restrictions on how much you can buy, but you can go through a broker dealer and buy more than that. It's just with the interest rates being so low, the guaranteed portion of it being so low, and there's a lot of them are selling at big premiums. So inflation had better stay really high, or they're not going to return much at all. And then if you had to sell them early, you could end up losing some money. So
okay.
I would just be
very good.
You can call me in the office if you want to talk more about it. So
okay, thank you.
Okay, have a good weekend. And I'm going to go to, is this JR?
Yes, hello, Professor Bullington.
Oh, hey, how you doing?
Okay. I would like to ask, I hold a fair amount of Home Depot stock, and it has been on a tear and a half. I'm just wondering what you make of this.
It's breaking out. It broke out actually a couple times. And here, let me pull it up, because I don't have access to their financial statements right in front of me. So if you bear with me just a minute,
okay,
I'll get it. By the way, that stock, I had a client who had original certificates. Now, this is going back a long time ago.
Sure.
He had original certificates. He had invested $10,000 in Home Depot stock. I had to I had to look it up for him. And it was in the early 1980s, and this was around 2000, that I was looking this up. And that stock, the 10 grand, I believe it was worth $500,000.
Yeah.
$10,000.
It's a real cash machine. I have had some of it since it was available at $32 a share. Not all of it, unfortunately, but it's just incredible. I wonder how much more it can go. I mean, it's very well saturated throughout the marketplace. It's a huge market, of course, but it does have competitors, and the profits are great, but it's retail.
Yeah, actually, I'm looking at. I do have it here now, and they've reconstructed some of what I am doing.
They do have a good web presence. I use them as a supplier also, but it's just it's astounding what that. I mean, for a big company like that, you say, well, you can't turn a battleship around very quickly. Well, this is one battleship that seems to be fairly agile.
Well, they've had a really good run. I think right now the price to sales ratio on it, according to Y charts, is 3, which would be normal. That would be pretty normal for a company that has the growth rate and the profit margins that they've experienced. You just don't want it ever to slow down much, because it will. Sure. It's not a super undervalued stock, but it's not overpriced by much based on what they're doing right now. So, that's it.
Okay. Well, it just has been totally fascinating the last couple of months. I just, I always think, well, is it time yet? Is it time yet? And never stops to amaze those people that follow it.
Yeah, it's actually done very well. Most companies over time, they pay attention to sales and profit margin growth or profit margins. They have a tendency to do pretty well. Not all of them. It is hard. I shouldn't say that. Owning a business is tough. Look up the statistics sometimes of how many businesses actually make it. And by the way, Home Depot peaked around $69 in 2000, okay, and it got as low as, let's see, what was low there? It was down to 23 in 2010. So if you're at $60 in the year 2000, and 10 years later you're down to $20, or actually, right around $20. Actually, it was $17, 17 and a half. That is a long time. 10 years, and you're down almost three-quarters. You're down by more than 50%. So if you have, and this is what I'm constantly telling people, this is why most people do not belong in stocks. If you were down more than 50% 10 years after you'd made your purchase, how would you feel?
Not too happy. Not too happy.
Do you think you'd still be in the stock?
Well, at one point, Bill, it was paying about a 4% dividend.
No. You have to answer my question first. Do you think you would you still be in the stock if you were in it?
No,
it was down
no,
10.
I probably would not. I don't have that kind of patience.
Right. And that's what makes Warren Buffett so much different than the rest of us. That dude has the patience. By the way, he also owns a whole bunch of businesses directly, so when the cash comes in, he would have been buying more shares of Home Depot that entire time if he really liked it, if he thought that they had a competitive edge. And there are a lot of companies that he's done that with. It really, quite frankly, they haven't done that well, because it's going to happen to anybody that invests. But that's my point. I always get people calling in when a stock is reaching its all-time high or its 52-week high and going, wow, do you think that can go higher? Well, it can, but then it can go down 50% and take 10 or 12 years to recover, too.
Absolutely. Well, that's why we use stops and covered calls and things like that.
Well, yeah, and you hope that that goes well, because that's no picnic either. Yeah.
No. What does Jim Cramer say? That
bulls make money and bears make money. By the way, he didn't make that up. And pigs get burned.
It's a good thing, regardless. Yeah. And pigs get slaughtered.
Yeah. Yep.
Okay. Thank you. Have a nice Thanksgiving.
All right. Thanks. You too.
Yeah.
Bye-bye. Yeah. And sorry for the tone. It's just, I get that a lot. People, they're braver when something's making an all-time new high than they are when it's making a new 52-week low. It's just that it's human nature. And that's one of the reasons I think funds are so important. If you are interested in trying to make money sooner rather than later, if you're interested in trying to outperform a market cap weighted index, which basically the S&P 500 is, there are funds out there that have better long-term track records than that, and they manage those stocks on an ongoing basis, and that makes a big difference. Instead of having to put up with a Home Depot stock, which, incidentally, I'm pretty sure that $10,000 stock certificate that was found in that guy's basement, that client of mine after he passed away, I'm pretty sure that if that had been in one of his accounts and somebody had known about it, they would have sold it a ton of times, because that stock had had multiple 50% or better drops. And that's one of the things that I read when I first got in the industry was, Peter Lynch said, if you can't stand to see the value of your stocks drop by 50% or more, don't buy stocks. And Warren Buffett said the same thing. I thought they were kidding. I literally thought that they were kidding. And anyway, we'll come back to that right after these messages. This is Bill Bullington right here on 1420. Stay tuned.
I'm gonna wrap my arms around my daddy's neck and tell him that I've
we're back. Okay. So, I just have to say a couple things about the guaranteed portion of people's money today. First of all, the guarantees that you can get out there, if you're looking at government bonds and CDs, the rates are extremely low, which is why you've heard me talk about fixed indexed annuities, not indexed annuities, fixed indexed. And by the way, annuities, there are thousands of types, and it is just mind-boggling. I just can't believe it. And everything's gotten so complicated today. And I feel so bad for the average person because you have to sit out and try to go through and read a lot of this stuff. But I guess it's okay for me. It keeps me busy, that's for sure. Not sure it's a good busy. But anyway, if you've got a fixed index, that fixed word there is very important. It means there's a guaranteed return there. You need to find out what that is. You make decisions. I've been talking about a couple different products here over the past few months, and we'll continue to talk about it because interest rates are so low. I just think it makes sense. And by the way, with the amount of money that's been spent, but a lot of it on the pandemic, and rightly so, ultimately that does lead to higher inflation, which I don't know if with the amount of debt that the government has accumulated that they would have the guts to start raising interest rates anytime real soon. And that's that can be a problem. And the inflation adjusted products, that the problems with a lot of those bonds I'm seeing is that you have to pay such a big premium. A premium is what you pay that's over the actual value of the bond. You pay such a big premium that the return, once you factor that premium in, is not very good. It's just like CDs or normal government bonds. They're just very low. So if you're looking for a return and a guarantee, you might want to consider looking into one of the newer annuity products that are out there. Depends on what you want to do. If you're looking to generate income right away, that's that's a specific type of a product. If you're looking to take income down the road sometime and you have an idea when that is, and it's going to be within 10 years, there's a product for that. If you're looking to generate an income but protect your downside and participate in the stock market, okay, you won't be able to do that with the fixed indexed. Those are not direct investments into the stock market. They're buying options on futures contracts, which is a lot different. It's actually safer, but it's also a lot more expensive. So you're not going to, those expenses come out of the investments, so they're not going to earn as much as a fund that invests directly in stocks would earn, assuming that market conditions are pretty normal over the next 10 years. If they're abnormal, if you get another period like the 1970s, where the Dow and the S&P 500 were basically underwater for 10 years, then you'll probably wish you had taken the fixed the fixed product that has the higher interest rate. There's a combination there that you can get. You can get the chance for growth because we all know if you held on to those same stocks you held in the 70s and made not a whole lot of money, but in the 80s you made a boatload. Okay, it's all on time horizon. How much time do you have? You call that sequence of events risk. That's what the financial industry likes to call that. Well, if you looked at the period of the 80s, it looks really good. You look at the period of the 70s, it doesn't look so good at all. So are you retiring at the beginning of the 70s or the beginning of the 80s? That's going to have a huge impact. And unfortunately, you can't know what that's going to be ahead of time. If you could, I wouldn't have to work. I'd be richer than Warren Buffett. All I have to do is get that right one time. If I can get one 25% move right one time, I have a strategy that I could retire on. Okay. And that's all I got to do. That should tell you how hard that is. Because it is, I'm going to tell you, it's almost impossible. Some people do it. There was this one guy, Victor Niederhofer, for, I can't remember how many years it was, but he was doing this really risky thing, and it seems so easy. Every month he's up 1.5%, 2%, never a down month. And he'd done this for almost 2 decades. And then one day he gave it all back, lost all the money in the fund, lost all of his own money, and lost so much money that he couldn't make good on. He bankrupted the brokerage firm that was taking his trades in a day. So yeah, there are things you can do, and I know people, they get attracted to these really risky things. Let's do these risky things. Well, no, if you're going to do that with a very small percentage of your money, and don't borrow money to do it. Don't use leverage. That's why he lost so much money. He was, he's investing 20 times more than the amount that he had in the account. Crazy, right? Well, for 22 years, it worked really well until it didn't. And that's my point. So a lot of there are a lot of annuity products out there. They're coming out with new ones all the time. And they've always done that, but over the past 3 or 4 years, I think it's the fastest rate that I've ever seen. And it used to be, could rely, it was like once a year, maybe once every other year. Now it's like every 6 months they make adjustments. So, and once they make adjustments, a lot of the older products they actually put on a shelf somewhere. So if you want to learn more about guaranteed income and what may be your best alternatives, just hit me up. Send me a message. I'll give you a call. It's a phone call. There's no cost to doing that. Free consultation. I'll at least let you know what I see out there as available options. I'm open to looking at the options that you have or that you come up with. It's really interesting. The guy asked about tips because there were 2 other people this week that had asked about that. Nobody's asked me about that since they actually came out with those things years ago. So all of a sudden they're going, hey, look. And one of them had a minimum. You couldn't invest more than $10,000 in it. Well, that's not a lot of help. $10,000 is not a lot of help. If you're getting 7%, which is what the headline read, and it wasn't 7% when you looked into it, it was actually a lot less than that. But even if you got 7% on $10,000, that's not a lot of money. It's like $70. I'm sorry, no, it's $700. Is that right? Boy, don't get old, people. I used to be able to do this stuff. You just move the decimal place. But yeah, it's like $700 on $10,000. That's 7%. Anyway, I'm normally at this time I talk about individual stocks, and which again comes down to risk management. If you're going to buy and sell individual stocks, when people call in and Jerry, I'm upset with myself that I take such a harsh tone. But you ask the same question for the past 20 years. I'm sorry, I apologize. It's just getting a little old. You know what the answer is going to be. That's the thing. You know what the answer is going to be. And I don't know why. You're just hoping at some point in time I'll break down and tell you what you want to hear and tell you I can predict the future with a high degree of accuracy. And I'm sorry. I'm never going to do it. And you're a great guy, by the way. This guy's a super nice man, and he's extremely intelligent. But he's always trying to do the impossible. I got to hand it to him. He doesn't give up. You got to have that if you're going to be successful in stocks. You got to be willing to hang in there and take it. And I just keep losing my sound again. So anyway, I always like to end the show by talking a little bit about the stocks, the breakout stocks. Go to look out for the bull. Everything that you need to know is in there. I think we're going to make a little adjustment this year because I think it might help to get people to understand and give them a strategy that's worked for an extremely long time period. Now, it doesn't work like you want it to. You will never find something that's 80% accurate. That guy, Niederhofer, he was using a strategy that was 97% accurate. Okay, but that 3% of the times that it lost money, it would lose everything you owned and then some. Not a good idea. And that's what happened. That's exactly what happened there. But if you want to win on more transactions than you lose on, you got to have billions of dollars for that. Those are guys that are front running orders. I forgot what they like to call it, but you got to have huge amounts of money to be able to detect the orders that are coming in and jump in front of them and then sell right to those big people that are the big orders that are there. And there are some firms that do that, but for the vast majority of the public, it's not going to work. What can work for you, and this is all in your head, is look at the stocks that are going up really fast right now. And just look at those if that's what you're trying to do. And by the way, almost nobody should be doing this anymore. I do it with a very small percentage of my money just because I've done it for so long. I hate not doing it. Okay, but if I lost every dime in that account, it has no impact on my life whatsoever. So under that condition, then sure, there's a company called Plug Power. Now, I have a client out there who's been in this stock for a long time. And actually, I've got about 3 of them. And you know what? It's on another run. I like the valuation on it a whole lot better today than it was before. I like what they do. The symbol is plug, P-L-U-G. Got a classic breakout chart pattern. Read the instructions on Lookout for the Bull at how to invest in that. And we'll talk about it a little bit more next week when I'm back again right after Thanksgiving. Have a good week, everybody. This is Bill Bullington right here on 1420. I'll talk to you next Saturday.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420. The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.